Dear children, now we are going to discuss this chapter, financial market. We already knows that every business requires finance. For some people, finance may be sufficient. For some people, it may not be sufficient. The people here means the institutions, isn't it? So we have to manage sufficient quantity of finance. It should not be too much. We have already studied that in financial management chapter, that the fund should not be surplus, nor it should be scarce. So the balancing of this fund, the quantity of fund is actually provided with the help of financial market. So we will see in detail about this chapter. So this is a place, as we know, market is a place where people usually gather for the purpose of selling, buying, or exchanging certain goods, isn't it? So like that, we have the financial market mainly for selling or exchanging or even buying of financial securities, financial goods, we can say. Okay, so that is the basic meaning of this term financial market. So here they are actually a network of institutions. A lot of institutions are actually gathered together, or they are assembled here mainly for the purpose of connecting the people who are having surplus money and for connecting the people who are in need of the fund. Or we can say it is a place which connect both the investors as well as the potential buyers of financial securities, financial instruments. So it's a place that create and exchange financial asset, children. This is a place which create the financial asset. So when I'm saying financial asset, you should know the meaning. It is actually the share, debenture, bond, government security, whatever we usually discuss. You know about a lot of financial securities. We have already studied in, business studies class 11. We have already studied in one chapter source of finance about all these instruments, isn't it? So this is the basic meaning about financial market. It create the financial asset, it exchanges financial asset. Okay, now this is actually bringing together, we already said this term, they are actually bringing together both the lenders of fund as well as the borrower of the fund. There are some people who are having surplus money, there are some people who need money, so this financial market bridges them. They brings together all these two parties so that the money can be transferred from one person to another person, or it can be given to the entrepreneurs. It can be given from the investors to the entrepreneur borrowers. Entrepreneurial borrowers means, suppose if I'm going to make a new product or I'm going to provide a new service with my own intellect, I'm called an entrepreneur. So if I need to make this idea into reality, that process is called entrepreneurship. Okay, and the institution that I makes as a result of this is called enterprise. So this is actually, I'm saying I can be called as an entrepreneur. So I need money. So financial market are helping me for actually getting this money, which is actually made available. It is actually the money is made available into the financial market by those who are having surplus fund. Okay, children. Now, actually, the main function behind or the process is actually called the process. What is happening in the financial market is called allocation of fund, children. Allocation of fund. Allocation of fund means, suppose I am having money, surplus money. I'm a household. Okay, I'm a person who is living uh, in a home. I'm working somewhere and I'm getting this income. And suppose, imagine that this fund is surplus, then I can give this money to some other firm. I can give this money to some other potential buyers. Okay, so there are two alternatives through which I can, or the money, I means as an investor. Okay, I have surplus fund, I can give this money. Similarly, person like me will be there who are having surplus fund. So the allocation of fund can be done through mainly bank. Either I may give my surplus money to a bank, or I may give my surplus money to any other financial intermediary, so that this fund will be passed to the required business enterprise or entrepreneurs or for any industries. Okay, they can use that money for their expansion, diversification, modernization purposes, or they can use this money for working capital and even financial capital requirement. Okay. So this already we discussed, children. Household savers, these people, suppose I being a household, already I said I will be having surplus fund, I may not be ready to invest this money in a bank. So in that situation I can give this money to any other financial market. For example, I can give my money to a stock exchange. Stock exchange is actually a financial market, children. We'll come to see, or we'll discuss all those things later. But please understand, I can give my money to stock exchange so that I can buy some share or debenture which are being issued by any of the business firms. Okay, so here I am giving my money to a bank, or I am giving my money to a financial market, say stock exchange. Okay, so stock exchange is actually called a secondary market, children. Okay, we'll discuss about all those things. Okay, right? So the bank and financial market are actually the intermediaries between an investor and a potential buyer. Okay, so the process whereby the allocation of fund is done from a saver to a bank or to a financial market, that is called financial intermediation. Can be asked as a one more question also, children. What is in by financial intermediation? So if I am an investor, I'm giving my money to banker, or I'm giving my money to financial market directly, say to stock exchange directly, then this process is called financial intermediation. Okay. Now we will see another important area, children, functions of financial market. What are the main functions of a financial market? We already said it is actually mobilizing the savings. Those who are having surplus fund, that person may give money to a bank or to financial market so that this money will be going directly to an industry or a business firm for some industrial purposes or for some productive purposes. They are actually acting as a channel. They are acting as an investment area, avenue, whereby they are collecting money from household people or from investors, and they are giving this money to business enterprises. Okay, that is called a mobilization of savings. These are the second point here you can see is the price discovery. Another important function of financial market is price discovery. So what is this price discovery? It's quite easy aspect. Okay, actually financial market will decide the price for some securities, especially this is applicable for the second hand securities, or we can say this is applicable for a stock exchange where the already issued securities like share, debenture, bond are dealt with. Okay, the people like us, okay, there will be buyers, there will be sellers. So because of their because of their act only, the price will be decided. Okay, so the price will be determined because of the forces of demand and supply. You know these aspects, isn't it? You have already studied in economics. The price fixation will be based on demand and supply. Okay, so that is the price discovery part. Coming to the liquidity part, children, this is an important, major important function of a financial market is providing liquidity. You already know what is in the liquidity. Liquidity means the ability to convert a particular asset to cash is called liquidity. So, how the financial markets are providing liquidity? It is very simple. We already said those who are having surplus fund, it will be given by them to financial market, and there are people who are waiting for that cash. There are some people who are eagerly uh, ready to buy that cash which is given by a household, isn't it? So easily the money part will be easily sold. There is no waiting time. There is no issues for getting converted into cash. Nothing, no such issues will be there. Okay, conversion of a security to cash is very easy. That point is called providing liquidity. Then cost of transaction is very less, children, because the financial market are always there to provide information about the price of a security, whether a particular security is available or not, the cost factor. Okay, so the people need not have to waste much time for searching these kind of securities. It's already readily available. So that point is called a reduction in cost of transaction. Okay, so these are the major functions, children, channelizing the savings from household to industry or business. That is called financial intermediation. This is done with the help of bank or any other financial institution. Price discovery means you should understand that the because of the forces of supply and demand of a particular financial asset, price will be fixed. Liquidity part you already know. The financial market are always ready to provide cash to those who need. So the conversion part is very easy. There is nothing hard like converting a particular security into cash. The cost of transaction reduction, I already said the point, children. There is already information. The financial market are always ready to provide information on the cost, availability, and price of some security. That is called a so because of this, the transaction cost can be reduced. They need not have to travel here and there. They need not have to refer something extra, nothing. Everything financial market will be given information regarding a particular asset. Financial asset will be given by the financial market. Now, this is actually the classification part of a financial market, children. You can see here, financial market is classified basically into two. They are money market and the capital market. Money market, we will see in detail. And the capital market, you can see here. Actually, money market is a market for short-term security, children. Please understand. The maturity period of such securities will be maximum 1 year. Okay, it can be 2 weeks, it can be 15 days, 3 months, 6 months, and maximum 1 year. Money market. We will see in detail. Money market doesn't have a fixed place and all, children, but capital market opposite to that, that is for actually dealing in second-hand securities, and this capital market is actually serving the financial requirement for a pretty long time, say more than 1 year. Okay, it's like a more than 1 year. The needs of a company that is actually required for more than one financial year. Any securities can be issued with a more than maturity period, say 1 year, will be dealt in capital market. Okay, so capital market is divided into primary and secondary. In both primary and secondary, they are dealing with the debt instrument as well as equity instrument. In secondary market is also called a stock exchange. Okay, so in secondary market as well as in primary market, they are dealing in debt instruments as well as the equity instrument. Equity instruments, when I'm saying, basically it is equity share, children. Debt instruments are actually the debentures, bond, bank loan from other financial institutions, etc. Okay, so money market we'll see in detail. I already said money market is actually a market for short-term fund. Okay, short-term fund actually it is for a 1 year. Any company which needs a working capital requirement, basically they will focus in money market, children. Okay, and please understand that this is not a physical place. There is no physical place for a money market. It is actually an imaginary place. Those who want to be in the money market, they can access money market with the help of telephone or internet or such electronic devices. Okay, so basically they are dealing in short-term security instruments. Working capital requirement is actually satisfied with the help of money market. Okay, so that is actually temporary fund, children. Working capital is actually called a temporary fund. Working capital, I hope you know the formula. That is actually the excess of current asset over current liability. WC is equal to CA minus CL. You know the formula and all, isn't it? So that is actually the basic thing you should remember about money market. Now we'll see the features. The major participants here are not much individual children. Basically, they will be the Reserve Bank of India. Then we have the commercial bank will be taking part in that because they also have the financial short-term fund requirement. All these RBI, commercial bank, any other NBFC. NBFC means non-banking financial companies like your Muthoot Finance, Joy Alucas, even state government, central government, and any other big companies or even mutual fund agents. Mutual fund we have already discussed. Okay, so in detail, if required, I will say again. In any other situation, we'll discuss about mutual fund. Okay, it's actually an agent who helps an investor. Actually, mutual fund is it's a portfolio of or it's a mixture of both ownership fund and borrowed fund. It's a mixture of actually debt and equity. There are mutual fund agents who can help we people or people like uh, the people who are having surplus fund. Instead of investing in a bank or any other company or in any other security, they can invest in mutual fund. You just tell the ratio in which you want to invest. For example, 1 lakh, if you want to invest in mutual fund, okay, you just tell them that 70% should be going to the debt and 30% only should be going to the equity side. Okay, as a for the purpose of reducing the risk and all. So the participants here are RBI, commercial bank, NBFC, state government, any other large company, and even mutual fund agencies. Instruments already I said, children, short-term instruments. Short-term instruments means maturity period is less than 1 year. Okay. Then investment outlay means here actually huge sums of money are actually traded here. Okay, money market, huge financial requirement, because you can, we already said the participants are RBI, bank, large corporate company. So they all requirement, even though it is for a short term, the money involved will be huge. Duration, we already said 1 year, even 1 day to 1 year. There are 1 day instrument, there are 3 day instrument. We studied about call money, isn't it? Call money for 3 day, 5 day. Intercorporate deposit we studied, that is for 2 weeks or 1 month time, 3 month time. Okay, this all we have discussed last year actually. Then money market is actually providing you proper liquidity. Easily we can convert our cash or our security into cash. Okay, that is called liquidity part, children. And actually here the instruments are comparatively safer instruments only. All are since we are investing for 1 year and all the instruments actually in this year, money market instruments was there, but now it is actually eliminated. Okay, so we already discussed about the money market instrument like treasury bill, commercial paper, call money, public deposit, intercorporate deposit. Okay, so all these are actually providing a better safety to investors. We need not have to study in detail about all those instruments since it is excluded for the time being by CBSE. Now the like location part, children, we already said there is no physical location. You can't see a building, you can't see the land and all. Okay, everything will be done through telephone or over internet. The return for these kind of securities will be comparatively less, children. The rate of interest what we will get. Suppose if I'm investing in a money market security. For example, I am buying a treasury bill or a commercial paper or a public deposit I am investing. The return what I am getting will be comparatively less than a debtorship securities that are dealt in secondary market, like equity share, debenture, preference share, bond. All these will be dealt in secondary market. Okay, so in secondary market return will be more, money market return will be comparatively less. This is purely unsecured, children. You know the meaning of unsecured, isn't it? Unsecured means they are not backed with an asset. A company who have issued money market security, it doesn't have any kind of backing asset, children. Backing asset, that is called unsecured. That means in the event of winding up of a company, you can't ask that company to pay back your money by selling any of their fixed asset. That is not possible. That is why it is called a unsecured. But in capital market, there are many securities that are called secured. They are the debenture, they are the secured preference share, they are the secured debenture. All these are actually possible in secondary market. Okay, so for a company, unsecured instruments are actually risk free, but for an investor, unsecured securities are risky. So these are the features of money market. We already discussed about the participant, the instruments, duration, the amount of investment, huge investment, duration is 1 year, liquidity is fast, safety not that much, safety is there for an investment because you are investing only for a short time period, isn't it? Maximum 1 year. Location, it doesn't have any physical location, returns are actually less, and this is purely unsecured, it doesn't have any backing asset. Okay, so unsecured means this is a benefit for the company, issuing company who issues a financial money market security, but this is not at all good for it's not at all good for an investor. Money market instrument, just we will see, we are not going to see all these things in detail because it is eliminated from the syllabus, excluded from the syllabus. We have T-bill, we have commercial paper, treasury bill are issued in a multiple of 25,000. Okay, government only issues. They are also called zero coupon bond. We already said that. Okay, commercial papers are issued by credit-worthy company, blue chip companies. Certificate of deposit are actually the certificate issued by a company like a bank. When you are investing in bank, you will get a certificate of deposit, isn't it? So like that, in firms, if you are investing, they will give you certificate of deposit. Commercial bills are actually your bill of exchange. We have studied about bill of exchange in class 11th accountancy. You know bill of exchange. Then call money. Call money is actually a temporary adjustment made between two firms, maybe for 3 day or for 5 day, and the rate of interest is called a call rate. Now proceeding to the next part, which is the capital market. As the name indicates, capital market is a market for a long-term fund. It is a market for a long-term fund. Long-term fund means any securities that are having a maturity period of more than 1 year. Say more than 1 year means it can be 3 year, 5 year, etc. So capital market is actually enabling, or it is actually helping a borrower to raise the fund mainly for a huge time period, say a medium term requirement uh, between 1 to 3 year, or it can be for a long term requirement, say more than 5 years. Okay. Now, capital market is actually dealing in instruments, major instruments like equity share, preference share, debentures, bond, etc. For that, they will give a certificate or a document that is actually a certificate of title, stating that a so-called we are actually, or the investors are actually owners of a so-called company. They can be the owners, or they can be uh, uh, acting like a debtors. Okay, suppose if I am giving my money to a company as a debenture holder, okay, I am actually suppose I am supposed to get some money from the that company, isn't it? So for me, that company is a debtor, and for the company, I will be a creditor. So anyway, children, let it be share or let it be we are investing debenture or bond. This is all done in capital market only. For that, we will get a certificate. Which is stated as a share certificate or a debenture certificate. All the details will be mentioned in the details of the company, the address details, the date on which you have invested the money, okay, the time period, whether it is a secured or it is an unsecured, whether it is a cumulative debenture or a cumulative preference share, or is it a non-cumulative preference share. If you have any doubt regarding this term, we will discuss it later about the cumulative, non-cumulative, participating, non-participating. All these we have actually studied in last year in Sources of Finance chapter, children. So anyway, we are proceeding. We will now see the features of the capital market. Here, a lot of participants are actually there. Individual investors are there, foreign investors are there, many financial institutions, bank, RBI, like that. Many firms will be participating in capital market. But in money market, this much participants were actually not there. Especially individual investors were not there in money market. But we have the individual investors in capital market. Okay. So it's a market for long-term fund, children. That is the basic meaning of capital market. Mainly the securities traded are, you can see here, debenture, bond, preference share, equity share. And here the investment is actually done in small multiples. It can be 10 rupee, 100 rupee. Okay, one unit will be costing 10 rupee, 100 rupee, or maximum 1000 rupee. That means the price of a share or debenture can be 10, 100,000, like that. And also they are traded in a lot, say one lot or a 5 lot or a 50 lot. In one lot, there will be sometimes a 50 shares, or it can be 100 shares. It depends upon the discretion of a company, children. Duration will be medium as well as long term. We already said more than 3 year or 5 year securities, maturity period securities are only dealt in capital market. Liquidity, here also we can say liquidity is there basically in money market as well as capital market. The instruments are liquid, but when compared to capital market, money market instruments are more liquid, children. And this is high risky market, or we can say the instruments traded in this capital market are high risky securities. We already said about equity shares and all. You know, equity shares are the most riskiest of the securities. It is also called a risky capital. Owners are called risk owner, or it is also called residual owners, isn't it? You won't get regular dividend, nor you won't get your capital back during the lifetime of a company. Once it is liquidated, once it wind up, then only you may get your capital money. Correct? The principal what you have invested. Okay, the rate of return will be huge. Okay, children, this is for the investors part only, because in equity share they will get a huge dividend, or if it is a debenture means high rate of interest they will get. Now we will see the difference between a money market and capital market. We have discussed a lot about money market as well as capital market, so we are consolidating here. Okay. Yeah, this was actually the features. Now we will see the difference between money market and the capital market. So we already said all these points. Once again, I'm saying money market is a market for short term, maturity period is less than 1 year. Capital market is for a long term, maturity period is more than 1 year. Money market is actually serving the working capital requirement, but capital market is actually serving the fixed capital requirement. Major instruments dealt are bill of exchange, treasury bill, commercial paper, treasury bill, CD, etc. in money market, but in capital market, securities dealt are equity share, preference share, debenture, bond, etc. Actually, the nature is like a wholesale market. Money market act as a wholesale market, children, because the instruments will be having huge value. But capital market, imagine that it's like a retailer where customer can go and buy even a 1 unit or a 2 unit like that. But in money market, you can't buy in lot, children. Of course, in lot only, lot means huge value. You have to spend huge amount if you want to buy some securities in money market. That is why I said there are no individual investors basically found in money market. But in capital market, there will be individual investors. Now, the participants we already said, participants are actually the RBI, commercial bank, or any other financial institution. But in capital market, there are individual investors also, apart from central bank or apart from merchant bank, commercial bank, or even there will be some corporate companies in capital market. Okay, merchant bankers are almost like a commercial bank, but usually they are specialized in a process, or they are actually specialist in underwriting, children. Underwriting, underwriting we have studied in class 11th. Now, money market doesn't have a secondary market, children, but capital market is actually having another subdivision which is called as primary market and secondary market. Money market doesn't have such a support. Usually, money market doesn't have a financial location, doesn't have a building. The transactions are taken over through the telephone or any other way. But in capital market, this is actually done through the help of stock exchange. Okay, capital market is divided into primary market and secondary market. Secondary market is actually called a stock exchange. There is one more classification, but it's not required for your syllabus. Apart from stock exchange, there is one more institution called over the counter exchange of India, OTCEI. Okay, we are not actually dealing with OTCI. Now the regulatory part, money market is actually regulated by RBI because it is a central bank, but in capital market that is actually dealt by SEBI, Securities Exchange Board of India. Okay, so this is actually the differences between money market as well as the capital market. Okay, children.